Howmet Aerospace delivered a massive beat on both the top and bottom lines for their Q2 2026 earnings. I mean, revenue came in at $2.55 billion.
Right, which is up 24% year over year.
Yeah, easily beating the $2.43 billion estimate. And adjusted EPS came in at $1.33.
Up 46% year over year, just cruising past the $1.24 consensus.
Exactly. And management didn't stop there. They actually raised full year 2026 guidance, lifting the baseline revenue to $10.05 billion and EPS to 5.27 cents.
With Q3 revenue guided at $2.75 billion.
Right. So the stock surged in pre-market trading. It hit an all-time intraday high of $309.73.
But then a completely reversed course.
Yeah, violently reversed course. It closed slightly down on earnings day and pulled back even further the next day to $284.31.
Which is, a pretty dramatic swing.
It really is. So imagine you were analyzing a century-old industrial metals manufacturer, and during the Q&A portion of the earnings call, the CEO starts talking about launching giant solar arrays into space on SpaceX Starships.
Oh yeah, just casually bypassing terrestrial power permits to run artificial intelligence data centers in orbit.
I mean, that actually just happened on this call.
It was a wild moment.
But before we look to the stars and try to figure out why an aerospace company is suddenly an AI play, we need to answer a much more grounded question for you in this deep dive.
Right.
If Howmet crushed consensus, raised its guidance, and operates in incredibly high-demand markets, why did the market immediately hit the sell button?
Well, it really comes down to the brutal math of a premium valuation.
Yeah.
Yeah. When a stock is trading at the multiples Howmet has reached recently, the market doesn't just want a beat. It demands absolute unimpeachable perfection.
Across basically every single operating segment for the next 3 to 5 years.
Exactly.
Yeah.
So in this deep dive into the source material, we're going to break down the actual mechanics of Howmet's underlying growth.
We need to look at how they're physically generating these margins.
Right, where the cash is going, and most importantly, identify the specific execution risks that caused institutional investors to take their chips off the table the second this report dropped.
So to understand that headline beat, we have to look under the hood at the specific operational segments driving that $2.55 billion in revenue. And the absolute standout, the star quarterback of the quarter, is engine products.
Oh, without a doubt. Revenue for this segment jumped 32% to $1.373 billion.
And EBITDA skyrocketed 51%.
Which is just staggering.
Right. I mean, you have a single segment pulling in over half the company's total revenue, and it is simultaneously expanding its margins.
In heavy manufacturing, scaling up production like that is usually, well, it's like trying to change the tires on a car while driving 80 miles an hour.
Yeah, you almost always lose efficiency.
Exactly. Margin usually compresses while you ramp up. So doing both at once requires serious operational leverage.
So what's the mechanism there? How are they doing both simultaneously?
It lies in the specific nature of commercial aerospace demand right now, particularly the aftermarket for spare parts.
Right.
When we look at Howmet's consolidated numbers, their organic growth was 21%.
Meaning, even if you completely strip out their recent acquisitions, the core underlying business is just surging.
Right. And a huge chunk of that is aftermarket spares.
Right.
Think about it. When an airline buys a commercial jet, the OEM Boeing or Airbus gets a massive upfront payment.
Sure.
But the components inside those jet engines, like the advanced turbine blades Howmet manufactures, they operate in extreme heat and stress.
So they wear out pretty fast.
They wear out, and they have to be replaced regularly based on very strict FAA flight hour regulations.
And airlines can't just, buy a cheaper generic knockoff blade to save a few bucks on maintenance.
They absolutely cannot.
Yeah.
The regulatory barriers and the specialized metallurgy required mean Howmet essentially has a captive audience.
And that aftermarket demand carries incredibly high margins, right? Because the R&D costs were amortized years ago.
Years ago, exactly, when the engine was first designed. So as global flight hours continue to recover and exceed historical baselines, Howmet is selling more of its highest margin products.
Plus, their factory floor automation has reached a point where they can increase output without a linear increase in overhead costs.
Right. That is exactly how you get a 32% revenue jump to yield a 51% EBITDA jump.
Wow. Okay, so the organic growth is impressive, but we do need to factor in their recent capital deployment.
Yes, definitely.
Because the fastening systems segment also posted monster numbers. Revenue hit $589 million, which is a 37% jump.
Yeah.
But I'm looking at the timeline, and that was heavily aided by their recent $1.8 billion acquisition of CAM, Consolidated Aerospace Manufacturing.
Right, that CAM acquisition closed in April, so this is the first quarter we are really seeing its integration into the top line.
Okay, so how much of that 37% is just CAM?
Well, if you isolate the organic side and exclude the CAM acquisition, fasteners still grew double digits.
Oh, wow.
Yeah, so that demonstrates underlying strength. But you are right to highlight that the 37% headline number is very acquisition heavy.
So what's the real test going forward?
The real test for the fastening segment over the next 4 to 6 quarters will be whether Howmet can pull CAM's legacy operations up to Howmet's historical margin standards.
Got it. Let's move to the remaining segments. Engineered structures and forged wheels.
Because this is where the earnings sprint gets a little messy on the surface.
Yeah, I'm looking at engineered structures, and revenue actually dropped 13%.
Right.
In a quarter this hot, across a sector starved for parts, why is a whole segment shrinking?
I know it looks like a red flag on a spreadsheet, but it is actually a textbook example of strategic margin expansion.
How so?
The revenue drop was entirely driven by the divestiture of their Savannah disc forging facility.
Oh, okay.
In heavy industry, companies often suffer from what you might call revenue vanity.
Where they hold on to legacy, low-margin stuff just to keep the top-line number looking big.
Exactly. Even lost leading facilities.
Yeah.
Howmet's management made the deliberate choice to prioritize profitability over size.
So by shedding the Savannah facility, they sacrificed top-line revenue.
But they structurally improved the engineered structures segment margins by 170 basis points.
That makes sense. You cut the dead weight, the ship sails faster.
Exactly.
But forged wheels presents a completely different anomaly. Volume actually dropped 8%.
Right.
Meaning they shipped fewer physical wheels to their commercial transportation customers, but revenue still grew 14% to $316 million.
Yeah.
How does a manufacturing company sell fewer products but make more money?
It is the ultimate proof of pricing power, specifically through raw material cost pass-throughs.
The aluminum prices.
Exactly. The primary input for those wheels is aluminum. And aluminum prices spiked significantly leading up to and during the quarter.
Right.
Rather than absorbing those higher commodity costs and letting their profit margins erode, Howmet successfully forced 100% of that raw material cost increase directly onto their customers.
Let's break down the math on that for a second for you listening, because passing through costs can actually make your headline margins look worse, right? Even if your actual cash profit stays the same.
It does. Mathematically, passing through raw material costs dilutes your margin percentage.
Okay, give me an example.
Imagine you sell a product for $100 and it costs you $50 to make. You have 50% margin and you make $50 in gross profit.
Right.
If the cost of materials goes up by $10 and you raise the price to $110 to cover it, you are still making $50 in gross profit.
But your margin percentage is now 50 divided by 110.
Exactly, which is roughly 45%. So your percentage dropped, but your actual cash profit didn't.
Wow. And the fact that Howmet could force this pass-through in a quarter where shipping volumes actually declined.
It shows how essential their forged wheels are to the commercial trucking industry. Customers just accepted the price hikes because they couldn't afford to source the wheels from anyone else.
That level of pricing power and operational efficiency brings us directly to the balance sheet because all that flow-through is generating an enormous amount of cash.
Massive amounts.
The consolidated adjusted EBITDA margin hit 32.1%, up 340 basis points year over year.
And if you isolate the engine products segment we discussed earlier, margins there reached an astonishing 37.7%.
Unbelievable. That operational flow-through generated $479 million in free cash flow just in Q2.
Right.
And management turned right around and increased the dividend by 17% to 15% to 14 cents a share. But I really want to talk about the stock buybacks.
Oh yeah, this is where the capital allocation strategy gets controversial.
Right, because they have been incredibly aggressive on the buyback front. They repurchased $300 million of stock in Q2 and then front-ran the earnings release by buying another $200 million in July.
So they have bought back $800 million year to date.
Here is my issue with this. Management is buying back stock at average prices between $248 and $277 in share.
Near all-time highs.
Yeah, they're buying at all-time highs. How is that a prudent use of shareholder capital when the company is sitting on $4.5 billion in debt?
And they require massive multi-year capex for capacity expansion, too.
Exactly. Shouldn't they be hoarding cash for factories or paying down debt instead of propping up the stock at a record valuation?
It is a totally valid critique, I mean, it is a debate happening among capital allocators right now.
Yeah.
But if you analyze the balance sheet metrics and the specific mechanisms they're using to manage their debt, the dual-track strategy actually holds up.
Okay, convince me.
First, regarding the debt load, $4.5 billion sounds massive, but leverage is a ratio. Their cash generation is so high that their leverage ratio is currently down to a very comfortable 1.4 times net debt to EBITDA.
Okay, 1.4 isn't bad.
And management explicitly stated they are targeting 1.0 times by year-end. So the absolute debt number is large, but relative to the cash they are throwing off, it is not a constraint.
Even after writing a $1.8 billion check in cash and debt for the CAM acquisition just a few months ago.
Even after the CAM acquisition.
Yeah.
And more importantly, they aren't just letting the remaining debt sit there. They are actively optimizing it through financial engineering.
What are they doing?
Well, during the quarter, they paid down a Japanese yen loan. But the really interesting move was utilizing cross-currency swaps on a $300 million note.
Explain how that swap actually mechanically benefits them.
Sure. So a cross-currency swap allows a company to effectively change the currency of its debt obligations.
Okay.
Howmet took a $300 million liability that was paying a higher U.S. interest rate and synthetically converted it into a Japanese yen liability.
Because Japan currently has significantly lower interest rates than the U.S.
Exactly. By swapping the obligation into yen, they capture that lower interest rate, hedging the currency fluctuation risk along the way.
Oh, wow.
That single financial maneuver saved them $12 million in annualized interest expense.
That's pretty clever.
Right. So, to address your pushback, the underlying business is generating so much free cash flow, and they are managing the debt so efficiently that they genuinely do not have to choose between CapEx, paying down debt, and buying back stock.
The machine is running hot enough to fund all three simultaneously.
Exactly.
Well, you just mentioned they have so much cash they can afford CapEx at the same time, but what are they actually building? Because $500 million in capital expenditures sounds less like routine maintenance and more like they are preparing for a massive structural shift in the market.
Oh, they definitely are.
We know commercial aerospace is robust. They have multi-year visibility on the Airbus and Boeing order books. But the most surprising catalyst in this entire earnings call wasn't airplanes.
No, it was artificial intelligence.
Right. This was the revelation that forced a lot of analysts to rapidly update their financial models. We saw explosive 38% growth in industrial gas turbines, or IGT.
Yes, CEO John Plant called the demand extraordinary.
He noted that utility customers are actively coming back to the table to expand their outlooks and secure production slots years in advance.
So to understand why an aerospace metals manufacturer is suddenly an AI infrastructure play, you have to look at the severe limitations of the global power grid.
Tell me about it.
The data centers being built right now to train and run large language models require massive, unprecedented amounts of electricity. A traditional data center might require, say, 10 to 15 megawatts of power. The new AI hyperscaler facilities are demanding 100, 200, even 300 megawatts.
And the grid simply cannot support this with intermittent renewable energy like wind or solar. I mean, you can't have an AI training cluster shut down because it got cloudy.
Precisely the issue. These GPUs run 247 at maximum capacity. They need reliable, constantly available baseload power.
Right.
That reality is driving a massive, unexpected surge in demand for natural gas power generation facilities.
Because they can be spun up relatively quickly and run continuously.
Exactly. And the core technology inside a natural gas power plant is an industrial gas turbine. It operates on the exact same thermodynamic principles as a jet engine.
And Howmet holds over 50% global market share in the advanced high-heat turbine blades required for those industrial gas turbines.
You got it. Every time a tech giant decides to build a new AI data center, a utility company likely has to order more IGT blades from Howmet to power it.
But I have to play devil's advocate here because this is where the earnings call took a very strange turn.
Oh, the space tangent.
Yeah. During the Q&A, an analyst asked about the constraints on this power demand. CEO John Plant went on a wild tangent about potentially putting data centers in space.
Right.
He talked about building giant solar arrays in orbit to bypass terrestrial power permits and grid bottlenecks, launching 20,000 tons of equipment on starships, and beaming the data back down.
Yeah. I mean, he admitted it was decades away, maybe the 2040s or 2050s.
Right, but it really makes you wonder, is terrestrial power permitting really such a bottleneck right now that we are talking about orbital server farms? Or is management just trying to inject a little bit of that sweet AI hype into an aerospace earnings call to juice their multiple?
Well, the space tangent was colorful, sure,
Yeah.
but You have to look at why a CEO of a metals company is even thinking about orbital data centers.
Why?
It highlights how extreme the terrestrial power problem is getting right now. Getting the permits, securing the land, and connecting a 200-megawatt natural gas plant to the local grid in places like Northern Virginia or Dublin, it's becoming a multi-year logistical nightmare.
So the bottleneck is very real.
The bottleneck is real. But Howmet isn't just selling a futuristic narrative. They are physically pouring concrete today.
Right.
Because of this localized, desperate power demand, Howmet is aggressively building out physical capacity in Japan, Europe, and Virginia specifically to manufacture more IGT blades.
They stated CapEx will exceed $500 million in 2026, and it is going to step up again significantly in 2027.
Exactly. They are structuring their entire capital allocation strategy to capture the next massive wave of data center build-outs scheduled for 2028 through 2030.
Okay, so if Howmet boasts 37% margins in its biggest segment, massive multi-year aerospace backlogs, a cash printing machine that allows for simultaneous buybacks and debt reduction, and a surprise AI-driven catalyst in gas turbines.
Yeah.
I'm struggling to reconcile this with the stock chart. Are investors just being completely irrational by selling off on this print, or is there a genuine structural flaw in this outlook?
The investors aren't being irrational. They're being highly disciplined regarding the margin for error.
Which brings us to the valuation premium. You look at Howmet, and it is trading at a forward PE between 51x and 60x, depending on the specific trailing metrics you use.
Right, which absolutely towers over the broader aerospace and defense industry average.
Yeah.
That sits around 39x.
Analysts have high price targets. The consensus is up at $325.93, but trading at 60 times future earnings prices in absolute uninterrupted perfection for the next 3 to 5 years.
And perfection is incredibly rare over a 5-year timeline in heavy manufacturing.
Yeah.
The market looked at the incredible numbers, saw the massive run-up the stock has already had this calendar year, and started pricing in the specific macro and execution risks that threaten this valuation.
Because when you are priced at a 60x multiple, you don't get the benefit of the doubt if you miss a quarterly target by a single penny.
Exactly.
So let's outline exactly what those specific execution risks are. What could physically derail this momentum?
The primary threat is capacity risk tied to that elevated CapEx we just discussed. They're committing over $500 million to build out new facilities based on projected AI data center demand for 2028. If that end market demand suddenly slows down, or if the hyperscalers hit permitting roadblocks and delay their data center builds, that massive CapEx instantly becomes a drag on free cash flow.
You build the factories, you hire the workers, but the utility orders just don't show up.
Exactly. Suddenly, your return on invested capital plummets.
And we also have to factor in labor and integration risks. I noticed they added 485 net new employees in Q2, primarily in that Star Engine products segment.
Yeah. And bringing on 485 new workers in advanced manufacturing requires significant training time.
Right.
If productivity lags as those new hires get up to speed, those beautiful 37.7% margins will start to compress. You are paying wages, but you aren't getting maximum output yet.
Plus, they have to flawlessly integrate the $1.8 billion CAM acquisition.
Oh, for sure. Merging enterprise software, aligning corporate cultures, and standardizing manufacturing processes is notoriously difficult.
If they fumble that integration, they won't realize the cost synergies they promised investors for 2027.
Right. And they also aren't operating in a vacuum. There are massive supply chain and geopolitical risks completely outside of their direct control.
Right. Howmet is deeply, inherently reliant on Boeing and Airbus.
Yes. Let's say Boeing hits a supply chain bottleneck. They can't secure enough commercial seats or avionics chips.
So Boeing is forced to slow down airplane production.
Exactly. That bullwhip effect immediately travels down the supply chain and backs up Howmet's order book. Howmet might have the engine blades ready to go, but if Boeing isn't building the plane, Howmet can't recognize the revenue.
Wow.
Furthermore, analysts are consciously flagging broader macroeconomic factors. Geopolitical unrest in the Middle East can suddenly spike jet fuel prices.
Which devastates airline profitability, leading them to delay aircraft orders.
Exactly. Add in the pressure of higher for longer interest rates dampening overall industrial expansion, and the operating environment is incredibly treacherous.
So the takeaway here isn't that Howmet reported a bad quarter, or even that the underlying business is deteriorating in any way.
Not at all.
The sell-off was a classic case of multiple digestion. Investors took profits because when you clear the bar at 60 times forward earnings, any slight hiccup in aerospace supply chains or a minor delay in the IGT capacity rollout leaves zero margin for error.
Right. The market essentially said, incredible quarter, flawless execution. But you had to do all of that just to justify where the stock price is currently sitting today.
The expectations are astronomical.
And the market wants to see the physical cash flow from this AI infrastructure demand hit the balance sheet before they push the multiple any higher.
Which leaves you with a final paradigm-shifting question to consider as you update your models. If Howmet's most explosive future growth is increasingly tied to manufacturing advanced blades for terrestrial natural gas turbines, specifically to power AI data centers, are we mispricing them by continually comparing them to traditional defense and aerospace peers like Lockheed or RTX?
That's a great question.
This is a stock that is actively blurring the lines between heavy industrial manufacturing, commercial aviation, and critical AI infrastructure. As institutional capital rotates over the next few years, how the market defines Howmet's identity might be just as important as how many turbine blades they actually forge.
That is the true underlying narrative to watch closely.
Definitely. Make sure you follow the show for your daily, no-nonsense earnings coverage. Catch you next time.